Welcome to another Conscious Builder live here. And today we have Chad Robinson on with us. Chad, thank you so much for being with us today.
My pleasure.
So, Chad is a real estate entrepreneur and financing specialist with 25 years of experience in the mortgage and real estate industry. Welcome to another Conscious Builder. Oh, apparently I have my Facebook open. Chad grew up in real estate in a real estate family and is currently the president and owner slash broker of an award-winning 360 Best Interest Mortgages Inc., serving the Eastern Ontario area. Chad, the first question I have is, what is a real estate family? What does that mean?
That's a good question. So a real estate family, I've been born into real estate. My mother and father, my stepfather, my stepmother, everybody was in real estate in one form or another. My brother is actually as a real estate broker as well. My half brother works with me as an underwriter. My brother-in-law is a real estate broker. Basically, everything to do with real estate. My father-in-law is a home inspector. My brother-in-law is a fire marshal for the city of Kingston. So we're pretty much real estate in every aspect of our family in one form or another.
And is everyone just loves real estate? You know, is that, or are they just kind of falling into it in some cases because that's just kind of what everybody else is doing?
I think a combination of both. You know, it's when I was a kid growing up, I said to my parents, I'm never going to get into real estate. I'm never going to get into real estate. I see what you guys go through. Why would I want to do that? And tenants and this and that. And then I turned 18 and I realized, man, these part-time jobs I'm working for, whatever it was back then, $3 an hour, this is hard work. I can sell a house and make a lot more money. So
Right.
I got my license and haven't looked back.
Yeah. So what'd you start? So you started at like 18, if I'm correct,
I
right?
started
So
at 18 selling real estate and did that for several years and enjoyed it. I put myself through university selling real estate. And once I graduated, I expected to do international business and do, sort of high finance stuff. And that just didn't work out. It was, a different time. And then I realized, I love real estate and love finance. And then back then, mortgage brokering was really just for people with bad credit. And it was just starting to change where banks were giving mortgages through mortgage brokers. And then I got my mortgage broker's license and really shut down my real estate practice and focused just on the finance.
and the financing side, so that's kind of where your specialty is. That's what you love doing.
Absolutely. Yeah, I love the finance side. Putting the deal together was what really makes me excited. You know, solving that puzzle is kind of my passion and my superpower. So showing houses and, doing that side of the real estate business isn't just what makes me excited. It definitely paid the bills and I was really good at it. But putting things together, structuring unique deals, is what makes me shine now, and that translates really well into the finance business. So sometimes I do consulting with some individuals, and I help structure deals and put offers together, but not really as a realtor per se. Even though I'm licensed to do that, that's not my main target. I don't compete. I don't go show houses. I don't list houses or anything like that. But I am fully licensed, so I can give advice to my clients on how to properly structure an agreement or read an agreement and help just be basically a consultant on that side of the business. So it dovetails nicely into the mortgage brokerage.
Yeah, I love that. I love that you feel like that's your superpower, right? So you figured out not only what you like to do, but what you're good at too, right? So, which obviously it took a journey to get to. So let's get into that, right? So now we are kind of post COVID. We're coming out of who knows what's going to happen, right? But it's very different today than what it was 4 months ago. What are you seeing? Are you having to work that superpower a little bit more these days because of the new restrictions potentially? Like what's happening in the financing world?
Yeah, it's really interesting, Casey, that it's all over the map. So we have some lenders that are tightening up guidelines and basically not funding things, especially on the commercial side. They're really, really strict on it. We have some residential lenders that have put in very strict guidelines, and CMHC is a good example of that recently. They changed their whole policy on 5% down. They wanted a higher credit score. They put some tight restrictions. And funny
What
enough,
what restrictions did they put in?
well, they needed a higher credit score, so 680 instead of 650. They took out some ability for customers to borrow some down payment. And what were some of the other ones? There's two or three things. They basically made it more difficult for those investors, or you couldn't take down payment from borrowed funds. So let's say you had a home equity line of credit on a rental. You couldn't use that to use as a down payment to buy a new house, where previously you could. So
Okay.
yeah, so they just tightened the screws down a little bit, not massively, but enough. But interestingly, the other two insurers in Canada, Genworth and Canada Guarantee, did not follow suit. So the first time that I can remember that the three insurers now have different products, where before they were always identical, well, almost identical anyway. So
Oh,
that was
interesting. So yeah, so there's three. So now if it doesn't work with one, you can always explore those other options, right? Is there a reason why you go with one over the other?
there's personal preference. So historically, Genworth has been a business. It's a private enterprise. It's not a government crown corporation. So we would approach Genworth with deals that were made business sense. If something had a logic to it, we would approach them with that because they would make a logic business choice decision. If it was a humanitarian kind of file, we'd go to CMHC because their mandate used to be to provide housing for Canadians, and a lot of the industry now don't really think that's their mandate anymore. But so if there was that single mom that was applying for a house and the ratios didn't quite fit, we needed to have that exception. We'd go to CMHC versus Genworth because they were more human. Now it kind of feels that that's changed. That's not the approach. It's more bureaucratic and rule driven than they were before, less human. But it's definitely a change.
Yeah. So one of the things that Brian went before was actually sharing a story of one of his friends got approved, and then 3 weeks later found out that he was not approved. Is that why would something like that happen? Is that something that was just a mistake, or is that actually, is there a difference between what we think, as the public is required to be approved versus what's actually required? It's kind of like in the construction world. It's like, you watch TV and it's like, this is how, in like 2 hours, you can have a renovation that's perfectly done and there was no issues. And,
Yeah,
but
exactly. Yeah, everybody watch Mike's Homes. Sure.
yeah.
10 minutes, all done. Yeah, there's definitely a difference and a disconnect between what's required today to get approved for a mortgage versus 6 months ago or even a year or two ago. I mean, let's be honest, most people don't do a mortgage maybe once every 5 years. So it's very different than it was 3, 4, 5 years ago. And the reason why your friend might have been approved and not been approved, there's a lot of changes. Maybe they didn't have the right documentation. So this happens often where we ask the customer, we say, okay, give me your employment letter, or where do you work? They say, oh, I work for the government and I make $40,000 a year. Awesome. Great. And they type that in the system and they get an approval based on that. But then you get the letter in 2 weeks later and it says they're permanent part-time or they're on contract for 3 months or 6 months or something like that. And to them, they've been with the government for 7 years. They're on contract to contract to contract. And they're an employee in their mind. But in the banking world, they're not. So there's a lot of nuances like that. So one of the strategies we do in our office is we ask for all of the paperwork up front. This is, it's difficult to do and it's very time consuming for the customers, but we get their employment letters, their bank statements and their down payments and everything. And right now it's pretty much your DNA. So that we go through it ahead of time. It's a slower process at the beginning, but then we typically don't run into these problems where we're getting caught after we give an approval because something's changed.
Right. So, but does that paperwork need to be a certain age, right? Whatever. Because what if I submit a bunch of paperwork right now, but then I don't find a house for 4 months?
Yeah. So things like employment letters used to be valid for 90 days. So if we had an employment letter last year pre-COVID, it'd be good for 3 months, more than enough time to go find a house usually. But now because employment is so uncertain, we get that employment letter, but then we need another one that's less than 2 weeks old. So it's very frustrating for customers where, okay, I gave you an employment letter, a month ago. I'm like, yeah, I know, but that was a month ago. Your company could be gone. You could have closed down. They could have laid you off. And funny enough, the customers never understand this, but the employers, the banks actually call all the employers as well. Once you have a mortgage approval, they ask, is Jane still working there? Is this how much Jane makes? And people are like, well, why are they calling? I have an employment letter. The bank takes the philosophy of trust, but verify.
Yeah.
Right. So here's your documents. They're going to trust they're real, but they're still going to verify everything in them.
Right. That makes sense. Right. Because they have to protect their part of the deal. Right. So
absolutely.
So what about let's get into a few examples actually. So one of the things, I'll just speak from personal experience, is that it's always been difficult for me to obtain financing, being self-employed. Even though we've been in business 10 years, I actually draw T4 at the time. Before I wasn't, right? So I actually draw a salary. But even with that, they still consider me self-employed, which I
Right.
am, right? So what kind of tips, are there anything that you would recommend for people who are self-employed, other contractors,
Yeah,
anybody who really owns a business out there who's looking to purchase a home or anything for that matter?
absolutely. So 100%. So we work with a lot of self-employed clients. That's one of our specialties. But really, it comes down to really good paperwork. As it generally is a self-employed person, we're great technicians, right? We're great at our jobs. You're a great builder. I'm a great mortgage broker. But are you good at filing your taxes and doing your paper and getting them organized? So quite often we'll ask for a self-employed client to say, okay, have you filed your taxes? Oh, no, I'm going to get to that. Okay. First step is make sure all your your taxes are filed. And you paid your income tax. Step number one. Now the question is, what do you put as your income? So if you're incorporated and you don't need to take all the money personally, you can leave money in your company versus taking it out. Obviously, that has an effect, right? Your net income is lower. In the ideal world, you take out as much money as you want to. Let's say you want to make 100 grand. You take out 100 grand consistently year after year after year, and your income tax for your line 150 on your notice of assessment, or your net income, in other words, would be consistent at 100 grand. Give me 2 or 3 years of that, and that's kind of the very vanilla approach to self-employed financing. Most people don't do that. Most people's income when you're self-employed goes like a yo-yo. 1 year's great, 1 year's bad. 1 year you're struggling. I mean, welcome to being a small business, right? And COVID's going to hit a lot of small businesses, so it's going to be a little challenging. But to answer your question, I guess, what tips can you give? Get your paperwork organized. Make sure your taxes are up to date. That's really primarily the most important thing. We have a lot of lenders that will finance based on the cash flow of your business, but we need to be able to document it. So I had one customer for a while. He had like 5 different bank accounts. Some were personal, some were corporate. He would take money in from, sometimes some people would e-transfer them, and he'd forget, and he'd deposit it into his personal account, and then he'd transfer that into his business account, and then he'd have to transfer to another business account, and it was a mess. So, sometimes my staff, he literally had to put stuff up on a wall and like colored lines between different bank accounts. Those kind of things drive the banks nuts. Right. So be consistent and document as much as you can in a concise way.
Is there any advantage to buying your home through the business?
Your home, no, not in my opinion. It actually makes it more difficult, especially if it's an operating business. So the banks don't like to lend mortgages to operating businesses. And the reason why is that there's a liability perspective, right? If your business gets sued or something happens in your business, it affects the real estate. So typically in commercial, what you see is there's a holding company that owns the building, and then the business rents from that entity. So there's a layer of protection from a legal lawsuit perspective. Right. It's always a good measure, at least in my opinion.
Yeah, that makes sense. Now, what about, so I guess that actually answered my next question. So in terms of maybe doing renovations, for example, so somebody purchases a home, what are the options out there to get financing for that? Obviously we have to deal with providing quotes sometimes for people for that, but we're not really into the details of what people have to do to get that. Sometimes it's simple as just a line of credit. They don't really need to explain anything. But is there any options out there that are easy for people to access for renovations if they wanted to improve their house, or in my opinion, I'm interested, is there anything out there to improve the comfort and performance of a home? But typically banks just care about the pretty makeup stuff.
Yeah, absolutely. Well, there's 2 parts. One is a product that I'm actually developing, but the simple thing is something called Purchase Plus Improvements or Refinance Plus Improvements. And this is an amazing program that is really, really underutilized because a lot of banks and brokers don't understand it, number one, and the realtors as well don't communicate effectively to their customers. And what it basically is let's say you're buying that house and it's a 1970s house and it has green shag carpet and an ugly looking kitchen, and you want to renovate that and maybe let's say do the windows. So you're easily doing $40,000 of work to this home. But the customers have only $40,000 for down payment. Really simple numbers. I don't want to do all that work. I don't want to buy that home, Mr. Realtor, because I don't have the money to fix it. Well, we can say, okay, listen, no worry. You can take that $40,000 of renovation and effectively add it to the price. So let's just really simply say the house is worth 400 grand. Good luck finding one right now, but let's pretend. And you put the 40,000 on top of that, your house is now worth 440. And I base my mortgage, let's say we're doing 90% or 95% based on the 440. So you finance either 90 or 95% of all the renovation costs in the purchase price. Really awesome program. It's a cheap money, and mortgages right now are 2%. So it's almost free. The only two catch. You need to have a proper quote done when we submit the mortgage. So that's number one. So that's where you guys come in, is getting a good quote quick enough so that we can finance or get an approval. And now
which is almost impossible unless there's a set of plans.
Exactly. This is a catch-22, right? So a lot of offers are going in unconditional right now. So we have a little bit of time because the customers are hopefully closing for a month or two. But 6 months ago, realtors were calling me and saying, Chad, I want to do purchase plus improvement and you need to get a mortgage in 3 days. And by the way, I don't have my quotes yet. I'm like, guys, I need a quote to get the approval. So there's a bit of a catch-22. But so that's the first thing. We need quotes up front to get it. And the second thing is the bank will give you the money once the renovations are done. So you have a bit of a lag. And, this is where you really need to work with your contractor and say, hey guys, and I've done this many times, I have a full approval here. The money's at the lawyer's office. It's in trust. The minute we get a picture that the work is completed, you're getting a check. We can even give what's called a letter of directions to pay your invoice immediately upon receiving the completion. So typically the contractors feel comfortable with that, not all of them. And you take a deposit up front, of course, to start the work. But the bank needs to see the work's done because they don't want to give you money for a kitchen that never got replaced.
Will they just give you the money based on the quote, or are they going to base it off of what they think the value of the house is increasing to?
It's going to be the value. Well, there's both. It's going to be the value that it increases, no more than the quote. But, and they do that for a good reason. Let's say that you want to take a house and upgrade the electrical service from 100 amps to 200 amps. Okay, that's going to improve the value a little bit, right? But if it costs you $1,000, sure, you'll definitely get $1,000 of value. But if it costs you $20,000 to do that improvement, that's not going to increase the value of the house by 20 grand. So that would kind of top out. Another example is I had a customer once who got so upset. She wanted to do purchase plus improvements to change hardwood. So this house had brown hardwood. She wanted light, like blonde hardwood. And the appraiser went in and said, the hardwood in the house is perfect. There's nothing wrong with it. It's a color choice. They gave her no value. So, in most cases, though, that's pretty rare. In most cases, you're changing that green shag carpet to beautiful carpet or hardwood. You're going to get dollar for dollar value.
Yeah. So you'd have to actually do something. So now, how does that work? Like, say, in a house, maybe the kitchen, there's a lot of houses that were built 20 years ago or something that, have a decent kitchen and it might even have granite countertops, for example, but it's outdated.
Yeah.
Right. Are you going to be in a kitchen, like maybe it's a big kitchen, it's going to cost you 50, 60 easily, depending on what's happening there. Are you going to be able to get that much from the bank typically, or are they just going to look at it and be like, well, you already had granite countertops and a decent kitchen before, you're not getting that much?
Generally, kitchens, bathrooms, flooring add dollar for dollar. There is a cap though. It's 10% or 40 grand. So if you're exceeding 40 grand, it's topping out on the purchase plus improvements. There is some exceptions to that, but that's one of the caps. So you can't do like a whole house remodel under this program. It's meant for quick and dirty changes. It changes a roof, a new septic system, or something like that to help just the buyers, get in the door to these houses.
Yeah, like that. So you can easily you could do some windows and doors or something like that, right? Which are those going to be dollar for dollar typically?
Usually, yeah.
Yeah. Okay. Well, that's good to know because those are all questions that can come up when I have a lot of people that are looking to purchase a house, right? They're reaching out. They're like, well, we're just thinking of buying this, right? And it's really hard to guide them at that point, right? Because I don't have any details, but it's always good to have information like this.
We had a lot of customers. It stopped about last year because costs, as you know, construction costs have really come up in our region. But they were doing secondary suites. They were building them with almost at 40 grand plus some cash in. But so we were actually doing second suites under this program for a while.
Oh, okay, that's good. Now, what about for the people who want to maybe build their own home, right? So they want to buy land and build a custom home.
Right.
What are the options out there?
So construction financing is a whole different beast. It's really awesome. I love construction financing. I do a lot of it, and it falls into kind of two broad categories. One is the self-build category. So this is the homeowner that is also maybe a construction, a trade person. They're an electrician or a plumber, and they're in there. They're swinging the hammers at night. They're building this in the house their weekends. That's a little bit harder to finance. So it's a little bit more expensive. And then the other one is, you work for the government or you have a great job and you're hiring somebody like yourself that's a Tarion approved builder, and you're giving a turnkey product back to your customer. So the construction is based in draws. So as you build the home and as value is going up, the bank gives you money in stages. So typically you get money when the foundation's in, when the walls and windows come up. It's called lockup. And then when you start putting the drywall in and some of those systems, depending on the lender, you can have 3 or 4 draws. And I have some lenders that will give you, 10 or 15 if you really want them. But it's based on progress as you go through.
Yeah. So one of the things that I ran into when we built our house, like not the one that I'm in right now, but the passive house about 7 years ago when we started that process, is I couldn't actually put Tarion on my house, even though I'm a Tarion builder, because I was owning the company and also building it. They said, well, you can't put Tarion on it, so we can't even finance you. So I had to wait 2 years before I could get a traditional mortgage on it.
Yeah.
It was kind of strange, but if I want to build again, how do I get around that?
Yeah, it's tricky. So a lot of times I recommend customers, hire a builder like you, right? That is Tarion approved. You outsource it, and you have that third-party contract. It makes the financing cheaper, easier. Your takeout mortgage is better. If you sell it a year from now, it's better. The other thing is you can probably attest to, and I try to argue customers with this all the time because again, I've built a bunch of houses in the last 2-3 years as well, and when I phone up or when you phone up now, your foundation guy, he's going to give you a better price than Joe off the street that's never built a house before and will never build a house again. Yep. So a lot of times like, oh, the builder is expensive. They're charging me this markup. Like, yeah, but you're more than likely, number one, the people are going to show up. And number two, you're probably going to get a better deal. So what that project manager is charging you, you're more than likely saving from the tradespeople, and the work is going to be done right. So it's and the banks are way happier.
And you can carry on. So right, you have that basically insurance policy for 7 years.
100%.
So yeah, that's one of the reasons why we operate like an open book, right? So it's like we're going to give you costs, whatever discounts we get, we'll give to you, right? So we're actually working on our neighbor's house and we're getting like a serious discount, even with our markup on the windows and doors that we're renovating. Like they're still saving a ton of money.
Oh, absolutely. Right? So, and it's probably more than earn your fee just in that.
Yeah, for sure. So are there any usual speed bumps that come up when people are going through the process, or are there new speed bumps coming up now? Like you mentioned the changes to the lending for at least the like Genworth or sorry, CMHC, but are the banks doing anything? Is there anything extra that they're looking for at this point?
Yeah, so really they're giving a lot more scrutiny, especially to employment. That's one thing. Be prepared for more questions and don't be insulted. A lot of people feel very kind of violated by the banks going through their bank statements and saying, why did this transfer happen? Or why did this thing happen? And they're questioning everything. So just be prepared for it. It's not personal. The bank treats everyone this way. So it's a little bit about, checking our egos and realizing the bank is giving you money in a very economic, uncertain time. So number one, I say to a lot of my clients, and I've said this publicly, be grateful that we have lenders lending in Canada and they haven't pulled out completely. Back in 2009, we had lenders just exit the space. They're just like, nope, we're not doing mortgages, doors closed. And that hasn't happened for many reasons, but touch wood, that hasn't happened yet and hopefully it won't. So be prepared for more questions, be prepared for more paperwork, and just get it organized, get it in quickly. That's the big thing. The second thing to prepare for is uncertainty. And how do you prepare for uncertainty? If you're thinking about doing something in the financing world, if you want to refinance a property or renovate a property, or you're thinking about buying another one, do it now. Don't wait. 6 months from now, the products might be gone. Scotiabank, for example, they put a restriction in about lines of credits, where they are no longer allowing people to use line of credits as a down payment for a new house. So CMHC did that, and so did Scotiabank. Now, other lenders haven't, but they might next week. You just don't know. The products are changing all the time. Right now, they're positive. The trend line is positive, but things could change tomorrow. So if anybody's sitting on the fence, renew now, refinance now. If you're going to buy now. Don't think that just because I had a product last week, it's going to be available next week. It might be better, but it might be worse. We just don't know.
Right. And now what about, what are the options out there for people who maybe aren't going to qualify through the traditional lending model?
Absolutely. So there's a lot of different options on there. So once you put more than 20% down on a purchase, we're into a conventional world. So if you're putting less than 20% down, we have to follow the guidelines by CMHC and Genworth and Canada Guarantee. So we're pretty strict on there. Doesn't matter which bank we're going to, they're all rolling up to getting CMHC approval or Genworth. So there's some workarounds, but we're pretty limited. Once you cross the 20% threshold, we're now into conventional territory. There's a lot of different options. So as a mortgage broker, we all say we work with 30 or 40 different lenders. Really, it's about 10. We have access to a bunch, but we have our preferences that we all like to deal with. Some use different qualifying rates. So I'm not sure if you've heard of this, but many lenders qualify at what's called a Bank of Canada rate. Today's 4.89. We have a few credit unions that are qualifying people at the contract rate, so at 3% or 2.89. That makes
What's that called? Sorry, what's that rate called?
Oh, the contract rate versus qualifying rate.
Okay.
And that's a huge difference. If I'm trying to pretend, so let me back up. If I get you a mortgage today, your payment's going to be based on the rate you get, which is, let's say, 2.1%, 2.2%. That's your actual monthly payment. But when I'm running my analysis to qualify you, I'm using a rate of almost 5%, 4.89% today. That's a huge difference on qualification rate versus actual rate. Sometimes hundreds of thousands of dollars of difference of qualifying power. So once you cross that threshold into conventional lending, I can actually use a much lower rate to qualify you with some institutions. That might mean the difference of, even though you got turned down by a big bank, I have this whole other set of lenders over here that may still approve you just because of that simple, criteria. Just lender A uses 4.89, lender B uses 2.89, and I can approve you with lender B. Like at decent rates. This isn't even private rates. That's just, one option versus another. And that's one of the powers of working with a mortgage broker is we have those kind of flexibilities to plug and play where other people don't.
Right. So what are the other, you have the option, you can go to a lot of lenders, right? Do you basically shop around for people? So I actually asked you this flat out before. I said, why would I work with you instead of going to the bank?
Yeah, absolutely. So we shop, definitely. We get the rates every day from all the different lenders. And right now, the A lenders, it's a competitive space. So, TD Bank to Scotiabank to RBC to BMO, they're all relatively similar in interest rates. But that's only part of the question, right? Rates are only one thing. If somebody says to you is, I want a 40-inch by 40-inch window, what's your cheapest price? Each window is not the same, right? They'll both open and close. They'll both stop the snow from coming in, but there's some very big differences, right? Mortgages are very much the same way. People don't think that, an RBC mortgage is the same as TD and it's the same as First National. No, they're not. There's a ton. When you go to a lawyer's office and you're signing a stack of paper like this thick that are all the mortgage details, those are the stuff most people don't look at. We look at them. Penalties and prepayments and all these options that are in there. So that's one big difference. Why a mortgage broker? We actually try to put the right product for you and the right rate. And then there's a whole thing about qualifying, right? If a really simple example is if somebody has rental properties, one lender versus another can look at the income from your rental in vastly different ways, which would mean the difference of getting approved or not. In your case, as self-employed, Casey, is there's a lot of self-employed business owners that you go and you buy a vehicle, and you use this vehicle for your company. So it's a company car, truck, whatever, and your company's paying for that. But because you had to sign personally as a guarantee when you signed up for that vehicle, it's showing up on your personal credit rating, right? Pretty simple. You probably experienced this.
Yep. I learned that one the hard way. Got
Yeah.
it all fixed up though.
Yeah. So many lenders will count that as a liability you got to pay every month.
Yeah.
So that affects your ability to get a mortgage quite a bit. Even though your company's paying for it, your company's paid for it for 5 years and it's never missed a payment, they're counting it off of your personal income. But it's really business expense. So some lenders, not all, but some lenders will let me add that back to your income or disallow it. Basically, I take that payment out of your
Oh,
calculation.
that's good.
Yeah, it's a huge difference, right? If you have $1,000 truck payment, that's a massive difference on what kind of house you can qualify for. So customers walk into a branch, they're self-employed, again, I use $1,000 truck payment because a lot of contractors have a nice big, you have a nice big F-150 and, so they're not cheap. Or, they have a Bobcat, for example, or some other equipment they personally guaranteed. I see that often with contractors as well. And they're getting hammered because on the ratios are all out of whack, but those are all business expenses. So you can take those, we can add them back into the company and, separate personal from business a lot more than most branches can. And frankly, it's because the branch people generally, it's a very general statement, they're not as much trained and they're not mortgage specialists. They do RSPs and bank accounts and a whole mishmash of things versus just specializing on one product, which is what we do.
And even that they're probably not that great at. But anyways, side note. Sorry if I offended anybody, but I've had to deal with some people that were not that great. So one of the things I like the fact that you brought up that point is, be careful what you're co-signing for. So we recently just got company vehicles. We were just sorting that out for the team. And I went into the dealership. I said, look, first thing I said is that, look, I'm not co-signing for the vehicle. If that's going to be a requirement, I'm not even going to bother. Yeah. There's no point in wasting anybody's time, sort of thing, right? They're like, oh, no, we'll be able to sort it out, right? So, but that was the first thing, because I learned the hard way is that it affects anything, because the other thing that it also affects is your credit score, right? Because it shows up there. So I'm assuming that the lenders won't remove that, right? If you have that, because it's your credit score is your credit score. They're not going to readjust your credit score because you co-signed for that $1,000 truck payment, right?
Yeah, and that's a really important thing. I'm glad you brought that up. Your credit score. I just recently had a file I submitted yesterday. Young first-time home buyer. She's in her early 20s. Got some really crappy advice last year. 2 young kids, young family. She had a couple $1,000s worth of credit cards, $3,000 or $4,000 last year. Worked hard, paid it off, or paid them down, basically. And then the banker, whoever they were, gave them advice of you should reduce your credit limit on your credit cards. So she canceled 2 of her cards and reduced the other card to $500. So she went from maybe a $5,000 credit limit to $500. Well, of course, a $500 credit card, that's max, right? It doesn't take long to put $500 on the credit card.
Yeah.
So Equifax, the credit score, one of the credit bureaus, the computer looks at it and basically says you can borrow $500, and you're borrowing $500. You're up to your throat on your usage. So her credit score was low 600s. There was no reason for it. Her repayment was perfect. She had a car loan there that was perfect, but the percentage of balance to available was almost at 100%. So it was getting crucifying her credit score. So she got really bad advice.
So should we be keeping a low? Do they base it on percentage?
It's based on percentage. So ideally, you never want to exceed 20% of your overall borrowing limit, if you can.
And that's all of your credit cards together, sort of thing. Like you have a few. Okay.
Yeah, Equifax and TransUnion kind of aggregate it all. But again, I even try. I know we all have our favorite credit cards that we like to use for points and all those kind of things. But try to keep it borrowing below 20%. And some, not all credit card companies report the balance to the credit bureau on the statement date. So a little nifty tip: is if you pay your car down before your statement date, it won't report with that balance. Again, not every issuer is the same, but I've noticed that trend over the years.
Yeah, that's a good tip. But if they're looking, like if you have a few cards and one of them you use more, so it goes beyond 20%, but the other ones bring it down below,
Correct.
does that help, I guess?
Yeah, 100%. And
Yeah.
and don't close things. Now, again, if you're talking to a branch person, they're probably going to give you different advice. And different institutions do treat open credit different. So this doesn't apply across the board. But I always believe, and I've always been telling my clients for years, is that never close credit. Now, as long as you're disciplined enough not to use it, of course, because it does a few things. Number one, if you have old credit on your credit bureau that's been there for 10 years, 15 years, that looks really good versus just all new stuff. And if you can borrow 100 grand, but you're borrowing $5,000, any bank or the credit bureau looks at you and says, wow, you can borrow lots, but you're not a risk.
Right.
But that same borrower that would have collapsed everything could borrow 5 grand and is borrowing 5 grand, looks like they're at their max.
Yeah. No, that's really good. That makes sense. I like that they look at that way too, right? So they're kind of seeing that discipline.
Yeah.
Okay. So tell me a little bit about, actually, I want to dig a little bit into the custom home side. Somebody wants to build a custom home.
Sure.
You can get construction financing. Now, what do you do for financing for the lot?
So I usually tie it up with construction financing if you can at the same time. And the construction financing falls into the A world or the B world in construction financing. So there's a few main institutions that will do kind of reasonably priced financing for construction. And that's like prime plus one, prime plus two, maybe with a small fee. The challenge of them is they're very, very strict criteria, and they hold the draws they're very tight. The other option is you go through the private financing, which is about 8 or 9% interest. So a little bit more expensive, but it's for a very short period of time. It's typically you're building a home in a few months, right? 8 months, maybe to a year. I'm guessing that's the average what I've been noticing. And so a little bit more expensive route to finance, but you can build quicker and you don't get stuck with like ridiculous draw requests or, not draw requests, but silly rules and regulations.
Yeah. So one of the things, the question that I would get is I've had people reach out, be like, oh, we want turnkey. We kind of want you finance projects.
Yeah.
And I responded, I said, well, even we don't, but even if we did, it wouldn't necessarily save you money because we would have to charge those financing, right? Even if we're borrowing to make it happen, we need to cover our costs and then some if it's extra work. But even if we weren't borrowing, we'd have to cover our costs for the risk or something, right? So what are your thoughts on that?
Yeah, 100%. So when, previously when I built, the homes that I had built in the past, we had one set of homes that we built on spec, and the other set of homes are pre-sold. So the pre-sold ones we managed to get cheaper financing on. Funny enough, as a builder, it was a bad decision because we way underpegged the market and could have made way more money if we had sold them after the fact. So lessons learned. Chad, stick to be a mortgage broker, not a builder. So that, but you're right. The cost is the cost. So whether you're a builder financing it or they're getting it through on their own, the flow through should be the same. I always prefer the second tier financing construction. I'll give you a good example why. There was a main institution that used to do a lot of construction financing, but they were very rigid. So they gave you money at foundation. So they would do 50% of land value, which is the kind of the common thing. So if the land's worth 100 grand, they give you 50 grand for land value. They give you a draw when you do foundation in, and a draw when the house gets locked up. So literally when you can turn a key on a door, it's considered lockup. And of course you need your windows and all your windows and doors in. So this one customer had this bay window, this custom bay window that was ordered in. And in transit, it broke. So they said, oh, crap. And they couldn't, it wasn't just a pane of glass, like the frame broke, it was destroyed. So they had to reorder, remanufacture it. Well, it was over a month before they could get a new window in. The bank refused to do a draw because all the windows and doors were in. They were that rigid. Now, that institution is no longer doing construction financing, luckily, but it's cheaper sometimes to go through the traditional lenders, but you get those kind of really rigid, you're dealing with the bank, and the bank's rules are the bank's rules.
Yeah. Yeah, because you're dealing with somebody and they just have to follow the rules of whatever the bank has created, right? So they don't have any pull in that case.
Exactly. The
So
private lenders are really just, they're giving you 80 to 100% of the construction costs. You get out there, you could have a draw every week if you wanted. Oh yeah, I put up 5 more doors. Here's more money. They're a lot more fluid. They charge for it, of course, but it's a lot more fluid. And once it's built, then you very quickly switch from the construction lending to a regular mortgage at the end.
right. All right. Sorry, my wheels are spinning. So let's end with this. So I know you got something else on the go that you just launched with called, it's Private Mortgage Investment Corporation.
Yeah.
Share a little bit about what you're doing there, and then end with how people can get in touch with you and any other links that you have, because I know you have a lot of really great stuff going on.
Yeah, for sure. No, I appreciate it. Awesome. So it's been a career goal of mine to open something which is called a Mortgage Investment Corporation. And what these are is basically, it's not really a bank, but it's like a bank, where we bring investors' money in together. We pool all the investors in and then lend it out as private mortgages. And the investors are targeted to earn between 8 to 9% interest as an investment. It's RSP eligible, TFSA eligible, any registered investments. And it's really to lend to clients that don't fit the bank's criteria. So we do first mortgages and seconds, creative stuff that is just a good deal if it makes sense. Construction is a good example, or somebody, an entrepreneur that's buying a house or flipping it, and they need to come in there and they need a mortgage for 6 months. And they don't want to deal with the BS the banks will give you. You come to a private institution like this, where I know the real estate's a good deal. There's not really a risk of ever losing money on it, because you're buying a property in downtown Ottawa and you're going to renovate it and then sell it. You're not going to lose money on that deal. So that's what it's kind of for, and or second mortgages. We're giving out a lot of those. So anything that needs a bit of creativity is what for the borrower side, and then for the investors, it's good stable cash flow on real estate in Eastern Ontario primarily that are giving stable returns. So we're looking forward to it.
So are you looking for investors that want to invest with you and clients at this point? Because you launched, or you are launching, sorry.
Yeah, we're officially open now, but we're taking investors with money in probably first week of August. So an investment corporation, we're obviously, it's deal by deal, so that we need money and we need deals, both of which we have some already, of course. But as we're growing this business, it doesn't take long before millions, or dollars are out of, an average mortgage in Ottawa is $500,000 as a first mortgage. So you can imagine that, you do 10 of those and there goes $5 million. It's, so investors are always important, and good, creative, solid deals. So if somebody has a good deal that, is an opportunity, feel free to reach out. My mortgage brokerage website is bestinterest.ca. So you can reach us there. If you type my name in and Chad Robinson, you'll find me very quickly on social media. So go to our main website, bestinterest.ca, and my podcast is also called The Practical Broker. So that's something you can see us in all the major venues, and also on YouTube for the podcast.
That's awesome, Chad. I got a ton of notes here for my own stuff as well. So I definitely appreciate you and appreciate you being here on this show and sharing your wisdom. Once again, if people want to reach out to you, go through the website, I'm assuming, right? Through is the best place. And if for some reason you missed that, shoot us a message and we'll connect you with Chad. So Chad, thanks so much.
Thank you so much.